Introduction. A mutual fund is a financial institution registered with SEBI, Securities Exchange Board of India, that pools money from individuals or corporate investors and invests it in a variety of financial instruments or securities such as equity shares, government securities, bonds, and debentures. The investment objectives specified by a mutual fund in its prospectus guide the scheme's investments. Example. Imagine a mutual fund as a large basket where many people put their money. This combined pool is then used to buy various investments like shares, bonds, etc., just like how a basket is filled with different fruits. 1. Benefits of mutual funds. 1. Small investments. Example. If you have 500 rupees, you can still invest in a mutual fund and gain exposure to a diversified portfolio. This wouldn't be possible if you tried to buy shares directly with such a small amount. 2. Professional fund management. Example. Just as you would hire an expert chef to make a gourmet meal, your investment is managed by professional fund managers with expertise in finance. 3. Spreading risk. Example. Instead of investing all your money in one company, a mutual fund invests in many, reducing the impact if one investment performs poorly. 4. Transparency. Mutual funds regularly provide updates on the value of investments and the portfolio composition. 5. Choice. Investors can choose from a variety of mutual fund schemes based on their risk-return profile. 6. Regulations. All mutual funds are regulated by SEBI, ensuring they adhere to investor protection guidelines. 2. Net asset value, NAV. NAV is the cumulative market value of the assets of the fund, net of its liabilities. NAV per unit is calculated by dividing the net value of assets by the number of units outstanding. Example. If a mutual fund has total assets worth 1 million rupees and 1,000,000 units, the NAV would be 10 rupees per unit. 3. Risks involved in mutual funds. 1. Market risk. If the overall stock market declines, the value of the fund's portfolio may drop. 2. Non-market risk. Bad news about a particular company can affect its stock price, impacting the fund. 3. Interest rate risk. When interest rates rise, bond prices fall, negatively affecting bond funds. 4. Credit risk. A company might default on bond interest, principal payments, affecting the value of the fund. 4. Types of mutual funds. 8. On the basis of objective. 1. Equity funds, growth funds. Example. These funds invest in equity shares of companies like Infosys, aiming for capital appreciation. 2. Diversified funds. These invest across multiple sectors, ideal for investors seeking reduced risk. 3. Sector funds. Invest in a particular sector, like technology or banking. 4. Index funds. Mimic a specific market index, such as the Nifty 50. B. On the basis of structure. 1. Open-ended funds. Investors can enter or exit at any time. 2. Close-ended funds. These funds have a fixed maturity period and are generally traded on stock exchanges. 5. Investment plans offered by mutual funds. 1. Growth plan. Profits are reinvested, and investors benefit from capital appreciation. 2. Dividend plan. Periodic dividends are distributed to investors. 3. Dividend reinvestment plan. Dividends are reinvested in the scheme, increasing the number of units held by the investor. Example. If you invest in a dividend reinvestment plan, the dividends you earn are used to buy more units of the fund. 6. Rights of a mutual fund holder in India. 1. Receive unit certificates or statements of account within 6 weeks. 2. Receive information about investment policies, objectives, and financial status. 3. Timely receipt of dividends within 30 days of declaration. 4. Redemption proceeds within 10 days from the date of redemption. 5. Right to information from trustees about any changes affecting investments. 7. Active versus passive fund management. Active fund management. Fund managers actively select stocks or assets for the portfolio. Example. An active manager might choose to invest in companies expected to perform well in the upcoming quarter. Passive fund management. The portfolio replicates a market index. Example. An index fund tracking the Nifty 50 will invest in the same stocks as the index in the same proportions. 8. Systematic investment plan, SIP, investing a fixed amount regularly. allowing investors to buy more units when prices are low and fewer when prices are high. Example: if you start in SIP of 1000 rupees per month, you continue to invest regularly regardless of market ups and downs.